Greetings, everyone, and thank you for joining us today for the latest version of our story about what's going on in the world and how the world works. We're going to have a couple of interactive polls today to play with, and we're also inviting you to use the chat function because we'd love to get your questions and comments in real time and incorporate them into this conversation. And with that brief introduction, I'd like to let Yusuf take it away.
All right, thank you, Dave. And Lauren, why don't we actually start with one of those polls, just checking in with our audience, wanting to know how you all are feeling out there today. Got some options up here: anxious, excited, scared, hopeful, or other. And if your selection is other, please choose the word that best fits how you're feeling and let us know. So hopeful, leading the way, better than 60%. Second place is anxious at 32%, excited at 7%, and oh, we have our first other.
Oh, there you go.
Lauren, can you see what that submission was? I'm not sure what the other feelings are that we're getting in.
Whoever, we have 3 others so far, so feel free to type into the chat what your other descriptor is so we can see it. And then I'm going to go ahead and end this poll, and I'll share the results with everyone so everyone can see.
Lots of hope.
Yeah, I love it when hopeful wins the race.
So let's dive in. And we're going to be sharing our story for the day. And broad strokes, the agenda is we're going to look back at 2022. We'll talk about some of the highlights from the year. We're going to look forward into 2023. And then we're going to share some very important information that we feel all of our listeners and viewers need to know that came out of recently passed legislature, the Secure Act. It came through at the end of last year. And Lauren will take us through those pieces to close us up for today. As I said, though, we'll start with 2022. And here's the menu as we look back on the year that we just got through. We'll be looking at performance. We'll be looking specifically then at some pieces of the portfolio and try to gain a better understanding of how and why they performed in the way that they did. So we'll look at emerging markets. As our clients know, we made some changes in the emerging markets portion of our portfolio last year. We'll check in there. There'll be lots to say about value stocks and interest rates. We'll spend some time looking at how the tech sector performed last year. And we'll have a look at international stocks, just to gain a sense of how many of the components of our portfolio did in 2022. And no better place to start than a graph summarizing exactly what we saw happen in markets and with our equity or the stock portion of our portfolio summarized here on this first chart. So in purple, for the calendar year 2022, you can see the stocks in the Yesky Buoy portfolio down just about 12% on the year. Now, it's important to note that relative outperformance in down years is critical. The losses that we can avoid when markets are down just put the portfolio in that much better shape when things ultimately recover. So while being down 12% is not great, it's certainly much better than being down 18%. In orange, the S&P 500, you can see, was down by a bit more than 18%. That's not our benchmark. We just include it because folks always want to know what the S&P was doing in relation to our portfolio. The more appropriate benchmark is the ACWI, or All Country World Index. It's a global index, captures stock performance around the world. That's in blue, and that also was down about 18%, just shy of 18% in 2022. And finally, international stocks, as measured by the green line, the All Country World Index ex-US, so the world minus the US, down about 15.5% in 2022. So gratified, of course, and as always, to see our portfolio doing better than the benchmarks. Always gratified to be able to report that kind of information.
And beyond the benchmarks, the average portfolio was not actually down 12% because the average portfolio has a non-trivial allocation to bonds and cash,
which did better, relatively better than any of the indices that you see posted here. But what we saw in 2022 was not necessarily unique to 2022. In fact, if we look at the past 2 years, we can see that our portfolio, again, it's the same four lines that we're looking at here. Our portfolio measured by the purple line leading the way at 9.3%. Another way to think about it, average annual return, net of fees, by the way, of 4.5%. When you compare that against the same indices, it's the same story here. We outperformed our benchmark, the All Country World Index, on average by 5% per year over the past 2 years. And that's no small feat. So just pointing that out, also outperformed the S&P 500 and international stocks as well. But relative to our benchmark, to be outperforming by 5% per year, again, happy to be able to report that. And we can even stretch it back further. Since markets bottomed out, since the current cycle began, whether we're looking at financial markets, the economic cycle, take your pick, our portfolio has done better than each of the other 3 indices that we're showing on this chart. On average, since March 23rd of 2020, our portfolio has returned, and the stock portfolio, I should say, an average annual return better than 26%. The S&P ringing in at 23%, so ahead of the S&P by 3% each year. The All Country World Index up by about 20% per year, so beating our benchmark by 6% per year over the past almost 3 years, and beating international stocks by a comfortable margin as well. So that's been the story over the past year, 2 years, 2 years plus. Our portfolio has done quite well relative to the benchmarks against which we measure its performance. Now we're going to talk about why. So we'll take a quick stop to look at emerging markets. This is the shortest piece of the story that we're going to spend time on today. As you know, if you've been reading our materials, we made some changes to the portfolio last year. We got out of China in our standard portfolio. So 30% of the emerging markets fund that we used to employ, it's depicted by the purple line on this chart, about 30% of that fund was invested in Chinese companies. We came to a decision last year that because there was an alternative available that did not have the same exposure, it was emerging markets just with no Chinese stocks in it, we thought it best to make the move. We take a grounded, evidence-based approach to managing our clients' assets. We came to the decision internally that we didn't feel confident about the information being reported by the Chinese government. And for those reasons, we felt that given the opportunity to move into an alternative that didn't have those transparency and reliability issues, we could go ahead and make that change. And since we made that decision, if you look at the fund that we moved into, emerging markets, ex-China, that's depicted by the orange line, it's been a great run over the past 7 months, small sample size. So we won't overdo this, but just checking in and noting that the fund we moved into has been outperforming the fund we moved out of thus far by 3%. And that's just over the past 7 months since we made this change. We're going to spend some time here in this segment talking about value stocks. So one of the chief reasons why the portfolio has been doing as well as it has, and this chart specifically focusing on 2022, value stocks have outperformed their more expensive growth counterparts. Well, what makes a value stock a value stock? It's a stock that's had its price pushed down for any number of reasons and is therefore priced for higher returns going forward. Why do value stocks do better when interest rates are going up? Well, you have to come back to the definition of a stock's value. So a stock, any company, the value of a stock, how a share price is determined, is by looking at the present value of the future cash flows of that company. For a growth stock, you're looking at future cash flows way out into the future. You know, for a company that has a high price today and has performed well and has grown well, you know, think Apple, for example. If you're trying to figure out the value of Apple, you're discounting future cash flows from years and years and years way out there, all the way up to the present date. And when using a higher interest rate, that brings the number down, brings the value down. Whereas with a value stock, we're more focused for evaluating those companies on earnings in the near term, you know, the next couple of years, let's say. And so rising interest rates, when you're discounting those future cash flows back to the present day, don't have as significant of an impact. How does all that translate to your portfolio? Well, if you think about our portfolio, there are 10 mutual funds that we use for the stock portion of our clients' investments. Ignore the emerging markets and ignore real estate. Then you have 4 quadrants: US large, international large, US small, and international small. Within those quadrants, there are 2 funds. One that's an index, kind of grabs the whole slice of the market, if you will. The other one doubles down on value stocks within that segment of the market. The value fund in each of those 4 quadrants outperformed the index fund by the figures that you're seeing on this chart. We'll focus on US large value and international large value, beating their more expensive counterparts, the index, in the respective cases by 12% in both cases. With specific interest on US large value, just because it's an easy comparison, our US large value fund outperformed the S&P 500, which is the index we use in that corner of the portfolio, by more than 12% in 2022. So we thought it important to show you this visual. It tells a clear story. Unsurprising results, but again, gratifying results nonetheless.
Well, unsurprising to us.
Certainly.
Not every investor believes in value stocks, but you know, our thesis has always been, I mean, and we can do that. You can do the math, and you can burrow down into the underlying economic drivers. But at some point, if you're buying earnings or assets more cheaply, you have more growth potential, more upside potential. And sooner or later, value will out. Sooner or later, but being able to buy the same earnings or the same assets more cheaply will pay off. Not every year, but in the long run. And the long run arrived in the last few years.
Yes, it did. And we're going to show you another chart that tells that story. But first, we want to take another poll here and just check in. So we're trying to capitalize on the value premium with the way that we invest, as Dave was just describing. So we're very excited about the value premium right now. We've got more to say on it, but checking in with our viewers today, when was the last time that you think we saw the value premium on display? So value stocks outperforming their more expensive counterparts on display in the Yeski Buoy portfolio. Responses coming in. About half of you have answered. Mixed throughout. All right, Lauren, I think we've gotten about 2/3 of the way, 2/3 of our viewers have responded. So, and we're sharing the polls you can see here. Kind of a trick question. In each of those instances, we saw the value premium come through, but here's the point that we're trying to make. There was a 3-year stretch, the rolling 3-year spread between growth stocks and value stocks that ended in 2020. the spread between those two had never been worse with respect to how value stocks were performing. You can see in that 3-year period right here in the middle, value stocks from July 2017 to June 2020 relative to growth stocks, there's a 20% disparity in performance. And we were getting questions from clients all the time as to why their portfolio wasn't keeping up with the S&P, which is skewed in favor of growth stocks, specifically tech stocks, which we'll talk about here in just a moment.
And I think it's really important to make it really clear, those were not the returns. That was the difference in returns. So value stocks didn't lose money. They just didn't make as much money.
Exactly. Yeah, that's the spread between the two, not the actual returns. The reason we invest in value stocks and overweight the presence in the portfolio relative to their more expensive counterparts is because the value premium is what we describe internally as a pervasive and persistent phenomenon, something you can see if you look at market history over the past 96 plus years. On average, value is going to do better, value in blue is going to do better than growth in green by an average of 3% per year. So, all things constant, on average, you're going to do better if you're invested in value. It doesn't, however, happen every day, and there may be prolonged periods where you're not seeing the premium come to fore, as it were. And, however, you also then have periods like this, where so for the last couple of years, value has been outperforming growth by a considerable margin. You can see here the spread here is 20+%. We're basically telling you what we told you on the last slide, just from a broader context. And so bringing it home and showing you how this translates to your portfolio, we'll just note, this is a chart showing you all of the value funds that are available through Dimensional Fund Advisors. The whole point of this illustration is to show you that we use them. And the funds that we are using in our clients' portfolios, the chart here is showing you outperformance relative to each fund's respective benchmark. So in 2022, for example, the U.S. Small Value Fund that we employ in our clients' accounts beat its benchmark by 11%. And then you've got the spreads here kind of throughout. So we use these funds. We even use a couple of the ETFs that are listed here as well. So if you're checking your statements, you'll see these funds have been working for our clients and doing what we expect them to do in an environment like the one we're in. Contrast that against what we've been seeing in the tech sector. So, through the latter part of 2018, 2019, even going into 2020, we were getting lots of questions. What's going on with the portfolio? Why isn't it keeping up with what I'm seeing at Amazon or the Netflixes or the Facebooks? Well, I should say Meta, excuse me, the artist formerly known as Facebook, Tesla, and so on. What's the deal? And so come around, the law of financial gravity applies in all cases. It does not discriminate. What goes up must come down. And so you can see in 2022, there was a massive pullback in that sector. And that has a lot to do with, by the way, you see the S&P 500 trailing our portfolio here on the far left. Well, the S&P was dragged down by each of these individual companies, which take up a disproportionate amount of the index. And so they were dragging down the whole index's performance for that year. And it's just something that we were in part insulated from. It's something that we didn't necessarily get to ride up. And thank goodness we didn't get to ride down either. And that's kind of diversification in a nutshell. We're going to pivot to talking about international stocks on the next slide. So I want to pause here. Dave, anything else you might want to add before we switch topics?
No, I think that this is one of those cases where a picture is worth 1,000 words. But it's also, for me, being a graybeard, literally, I watched this happen back in the decade of the 90s when the technology sector grew, and it kind of ate the S&P 500 by the end of the 90s with the dot-com frenzy. Technology had come to represent like a third of the S&P 500 index. And when the dot-com bubble burst, and took down blue chip technology stocks along with a lot of vaporware. It had a disproportionately large impact on the S&P because it's market weighted and technology had come to occupy so much of it. And in the last decade, we've basically seen the same thing all over again. Technology took over the index, and so the S&P was disproportionately hit by that fall. And this is a case where a lot of these companies, some of them, a lot of them had profits, but their future earnings prospects were not as rosy as their valuations would imply. And so this is, there was a famous article written by an economist named Burton Malkiel back in beginning of 2000, just before the dot-com meltdown hit. And he said that a price to earnings ratio, which is one of the ways we measure how expensive a stock is, has an implicit growth rate built into it. And he observed that the price to earnings ratio of Cisco, a very popular technology company at the time, was so high that the implicit earnings growth would suggest that in 5 years, its earnings were equal to the gross domestic product of the United States, a highly unlikely outcome. And it was literally within a month or two that the whole thing fell apart. And so this is where we say again and again, price matters. What you pay for something matters. And just because something goes up, just because you pay something and the price doubles, it doesn't mean it makes sense, and it doesn't mean it's going to persist in the long run. Buying things more cheaply, buying assets and earnings more cheaply is the recipe for success in the long run. Not every year, not even every 3 years, but over a longer period of time. That's what makes sense. And so we play the odds. We think because that's the most value-based way to go.
Here.
I said I had nothing to say, and then there you go.
The next segment of the portfolio we're going to look at, it's a perfect segue, moving away from U.S. stocks to look at international. You've got the S&P 500 here on this slide in orange. This is showing you performance since the beginning of the fourth quarter of 2022. So the last 4 months proper. The S&P is up 12%. That's great. It's just not 17%, which is what the All Country World Index has done, which is also lovely, except that's not 21%, which is what these stocks in the Yeski Buoy portfolio have done. And part of the story there in explaining our outperformance relative to the other two indices I just mentioned, look at the green line. Since October, international stocks around the world are up 24%, which is incredible. International carried the day, by the way, in the first part of last year as well, sagged a bit in the middle of the year, but have been on an absolute tear over the past 4 months. And there's a lot to like in terms of valuations. Dave, you were just mentioning, looking for buying stocks, buying investments at relatively low prices. The valuations internationally are still more attractive than they are in the U.S. Said another way, stocks internationally are still priced more cheaply than the U.S., even after this most recent bout of outperformance. So it'll be interesting to see how things play out as we go forward. All right, 2022 done, on to 2023. So the things we'll be looking at, inflation and interest rates. Of course, we couldn't let you go without saying the word inflation a dozen or two times. So we'll do that here coming up. Talk about bonds. We're going to talk about the job market, and we're going to address the elephant in the virtual room. Is a recession coming? But first, we'll talk about inflation. The chart here is showing you in purple headline inflation, CPI, the Consumer Price Index, has been trending in the right direction since last summer, which is downward. Things peaked north of 9% last year. As of the most recent reading, the 12-month inflation rate, 6.5%. If you strip out food and energy, you get core inflation, which is the orange line here. That's down to 5.7%, also moving in the right direction. If you want inflation as of the personal consumption and expenditures reading, which is the reading that the Fed places a high degree of significance on, that rate is down to 5%, also moving in the right direction. Now, the only line that's moving upward on this chart is the green one, and that's interest rate. So the federal funds rate, one of the tools the Fed uses to manage the economy, they've been raising that rate over the past almost year at this point. Started with some quarter point increases, then got really aggressive. There were half point and 3/4 of a point increases throughout the summer. Those increases have started to taper downward. The expectation, I didn't check the news before we got in, but the expectation is that today's rate hike would be 1/4 of a point, which would be, again, another signal from the Fed that, as we're seeing here with inflation, things moving in the right direction. If rate increases are decreasing in magnitude, that's another signal from the Fed that things are moving in the right direction as well.
I'll add one thing here. These numbers are 12-month year-over-year changes. Paul Krugman, in a column this morning in the New York Times, points out that if you just look at the last 6 months and annualize that, the rate is under 2%.
Which is the target for the Fed.
Right. And I think it indicates where we're already arriving much more quickly at their target than I think anyone really thought we would. There were a lot of economists who predicted that we would have to have a big increase in the unemployment rate for several years before we'd bend the curve on inflation. And it's just not looking that way.
We've got slides for that. As we mentioned, the Fed is meeting today. Expected rate increase somewhere between 1/4 point and 1/2 point. It'll be interesting to see what comes out of the next couple of meetings. The Fed gets together again in March and May. Presently, expectations are if rates continue to go up, the Fed may stop raising rates this summer. So keep your eyes peeled on the minutes and the announcements coming out of the June and July meetings. And then that'll be an indication of how the rest of the year is going to unfold. So again, we watch this stuff kind of nonstop. Just bringing a couple key dates to our clients' attentions, things to watch out for as the year continues to unfold.
So Yusuf and Dave, I'm going to butt in here with just a comment that I think is a good point to talk about. Our question is, Dave, you said from Krugman this morning that we're kind of getting back to where we want to be. So why is the Fed still raising rates? If we're getting back to where we want to be, why are we still expecting rate increases?
Boy, I mean, Yusuf and I probably could both spend a lot of time on that. I mean, part of the problem is that, in economic terms, rates as a policy instrument work with a lag, and they work with generally a pretty long lag. And, but it's one of those things. It's like so many different economic factors. It's not a predictable lag time. But when you try and turn something around, like the U.S. economy or the global economy, or in the case of the Fed, the U.S. economy, it's like trying to turn the Queen Mary. It doesn't turn on a dime, and so the Fed got caught flat-footed at the beginning of this spike in inflation, and they thought it would be less and more transient than it appeared to be, and so they then ramped up the rates to try and get ahead of the curve. And I think they're going to swing back to being a little more dovish now. I actually think that they don't want to be accused of politicizing anything. They don't want to be accused of softening the impact of higher rates in order to make political points for any particular party. And they, at the same time, they want to respect their mandate to maintain high employment. So they're walking a tightrope. The soft landing has almost never happened, but depending on how they handle the next few rate increases, I don't know, they might get close. So that was probably a bit of a ramble. I don't know what you'd want to add to that, Yusuf. Probably something more concise.
No, I was just going to say they're playing a political game. I mean, they don't want to be blamed for causing another recession, and everyone knows what the Fed is up to and how it's affecting markets, and everyone's hearing about interest rates and inflation, and it's a tough job. So it'll be
And
interesting
they
to
don't
see
want
how
to
they
be,
manage it.
yeah, they don't want to look soft on inflation. The problem is
Right.
that over the course of the last year, the headlines have been all about inflation and the outrage when people are paying higher prices at the pump and all of that. And nobody's been talking about the possible impact on unemployment, the loss of jobs, what it means if the economy goes into a recession. And partly the reason for that was that the economy just kept being strong in reality. As Krugman also pointed out in his column this morning, the US economy added 4.5 million jobs last year. So we had this spike in inflation, but the economy continued to chug along at a really high rate of growth, including job growth. And so, this is the thing they worry about. Even though the trend is down, they feel like they got caught flat-footed. They didn't move early enough, big enough for what we ended up getting in that inflation spike. And so now they want to be cautious on the backside. And hopefully their caution on the backside in terms of slowing rate increases doesn't send us into a recession. Although a recession is not necessarily a bad thing. The economy can have negative growth for 2 quarters in a row, which is a common definition. And it doesn't mean that the whole world falls apart. Probably means some people lose their jobs, employers hire less, or they even lay people off. It's not utterly without pain, but we can recover. The average recession is 9 months over the last 90 years. And a lot of recessions last for only a couple of quarters, the minimum definition. So, a 2-quarter recession could feel like a soft landing, I guess is what I'm saying. And so the Fed is taking the chance that they can achieve that while still being aggressive on the inflation front.
A great question, and it's one that's going to cause me to skip these next 2 slides. I'm just going to promise that we'll put a digest post together about bonds, and we'll cover this material. But Dave, your comments here, really it's a perfect segue to get into talking about the labor market and just where things stand in the economy right now. So let's just jump in and go there. We wanted to show you this slide because we think it's a really important chart to take in. Recession, indicated by the gray bar, that's the COVID recession. Okay, so that's the beginning of 2020. When COVID started, we've shown you this a number of times, 6 million jobs just vanished overnight. So you can see the claims for the initial claims for unemployment insurance indicated by the purple line. More important is the orange line. That's the unemployment rate. The big piece here to focus on is over the period beginning at January 1, 2020, and through these past through the middle of last year, and this continues, by the way. We'll show you another slide here in just a moment. We got down. It took this long to get to 3.6% unemployment, which is where we were before COVID. So we've been at 3.6% unemployment or thereabouts for the better part of 6, 7, 8 months. Same thing, claims for unemployment insurance have remained level at about a couple hundred thousand claims a week, which was the rate for claims before COVID. So the strength of the economy in terms of the labor market, in terms of employment, things look good. Now, this is a chart showing you how long it took to get back to the same unemployment rate we had before COVID. This is a chart showing you the last 2 years. 4 indicators. We're going to spend some time here just to make a point. In blue, inflation. So there's your CPI figure. Again, 6.5% as of the most recent reading for the prior 12 months. This is showing you 2 years. Okay, so we're looking at 21 and 22. You can see where inflation spiked up in the first half of 21. You can see where it continued to go up through 22 and then started to go down in the latter half of 22. Okay. What else are we looking at here? In purple, again, initial claims for unemployment insurance going down over the period. You want that rate decreasing over time. You want fewer people claiming unemployment insurance. That's a signal of health in the economy if this line is going down and to the right. In orange is the unemployment rate. As of the most recent reading through the end of last year, 3.5%. That's full employment by anyone's definition. And so even though, and here's the last indicator, even though the Fed has been raising rates, trying to slow down the economy and achieving the goal of seeing inflation come down, while we may be seeing layoffs in pockets of the economy, tech, for example, overall, the economy is adding jobs, Dave, as you just noted, and the unemployment rate is remaining level. Now, I'm not going to call this a soft landing, but this is a beautiful chart and it's telling a great story.
And we hope that, you know, I touched on this earlier, but there are a number of economists who believe that if the unemployment, we would have to get the unemployment rate back up to 5% and keep it there for possibly several years before inflation will really come down. Now, I think the empirical evidence that's emerging in the last, 6 months possibly tells a different story. But there are always competing models of how the economy works, including on the Fed Board of Governors itself. And you have to worry about what they're looking at in terms of bringing inflation down in a persistent way. I'm sure there are some hawks on the Board of Governors currently who believe that you're going to have to see a rise in the unemployment rate before there's a believable reduction, a persistent and sustainable reduction in the inflation rate.
So we have two questions I want to chime in with here that I think go well with this part of the conversation. The first one being a question about the inflation, the different measures of inflation. Why use an inflation index that doesn't use food and energy, which everyone is impacted by?
Because of the two most volatile parts of the measurement. Food prices and energy prices month to month could be all over the map and make what's already a pretty noisy indicator that much noisier.
And the other one that ties this and something we talked about a little bit earlier is, do we think that the recession risk really is only centered on the tech industry? Obviously, that's been height of mind in the headlines recently for sure, but do we think that's the risk there?
No, if anyone can say for sure, Dave, I mean, we're certainly seeing things happen in tech, but I don't know that just because that's what we're seeing thus far, that's what the headlines are focusing on, that's the whole story.
I mean, the problem is that, you can have individual industries can have a recession where the industries experience negative growth for a period of time. But when you talk about the economy as a whole, you tend to have these spillover effects. And so, for example, the minute people start to get nervous because they see the unemployment rate going up or they have neighbors who have lost their job, they start spending less. And they start spending less on everything. So, it's not just the new iPhone they're not buying. They're not buying the new bicycle, and they're not buying the new washing machine, and they're not buying the new car. And that causes those manufacturers to acquire what are known as unintended inventories. And so they suddenly can't sell as many as they thought they could. And so what do? They slow down production. You slow down production, you don't need as many people, they lay them off. But then that creates a downward cycle where then people who are laid off now have less spending power. So again, fewer products are being purchased in all categories, and those manufacturers lay off some more people. And at some point it stabilizes and we have the space for the growth cycle to begin again. But it's very rare for a recession to be entirely contained in one industry or one sector. So so if we actually saw the US economy as a whole go into negative growth for 2 or more quarters, I'm confident that that would apply to a lot more than just the tech industry.
We have one more great question that came in here on this topic. Won't the decline of working age people in the labor market, whether that's from retirement of baby boomers, long COVID, other issues affecting the country, won't that continue to apply inflationary pressure on labor costs, or will automation substitute for the loss of workers?
God, what a great question.
Don't know. I mean, time will tell. And I don't mean that to punt or as a cop-out, but it's just difficult to gauge. I don't know if you have a sense, Dave.
Well, no, I just think that the beauty of that question is that it recognizes that, you know, there's potentially a substitution effect between technology and labor. And, you know, when people talk about the fact that the US used to be a manufacturing powerhouse and then was no longer, what it actually misses is that the US is still a manufacturing powerhouse. It's just not generating a lot of manufacturing jobs for that very reason, because we're manufacturing more things with less labor because of technology being used to basically replace labor. I mean, there are some factories out there that are almost 100% automated, where there are almost no human beings at all involved. And so, you know, could the pace of technology substitution for labor make up the difference? You know, I think it could. You know, but we believe in human ingenuity, and on the technology front, humans have been pretty ingenious. The other thing that happens, though, when you have that graying of the population, less in the US than elsewhere in the world, but sort of globally, is that you end up having in a sense, a glut of savings, because the people that enter their golden years have tended to be, you know, more accumulators than young people are. They tend to have more savings. They often are more conservative. They chase bonds, and that's one of the things that has kept bond rates and therefore interest rates low for the last 10, 15, 20 years. Lower than predicted was the fact that you had this global savings glut that just wanted to buy US treasuries, drive up the price, which drives down the yield, which is the interest rate. So that, but of course, yeah, it's such a beautiful question, because demographics and the intersection of demographics and technology it's one of those things where economists in the future will be able to look back and tell us exactly what happened. But right now, looking forward, it's hard to know what that interaction is going to look like.
Perfect segue to jump into this as our final chart here in this segment. We have one more slide, and then we'll kick it over to Lauren for some policy updates. Talking about great questions. We keep getting this one. Is a recession coming? Is a recession coming? And when? Yes, a recession is coming at some point. When is anybody's guess. Might we have already survived one? Dave, you mentioned the traditional definition of a recession: 2 consecutive quarters of negative growth. This is real GDP adjusted for inflation. The 2 quarters circled here are the first and second quarters of 2022. That line is moving downward in both quarters. Was it a recession? It has yet to be called one by the National Board of Economic Research. It may be dubbed one down the line. As of yet, no. Are we in one now? Well, no. Real GDP for the last 2 quarters is on the up and up, up 3% as of the most recent reading. Why are we showing you this chart? In purple is the Yesky Buoy stock portfolio. You can see that the shape of the 2 lines that we're looking at are very similar. We're looking at a timeline since the beginning of 2020. Here's the COVID crash. Here's the recovery. Here's what happened in the economy, which is not the same thing as what happened in financial markets. They're related, but not the same thing. Financial markets tend to be predictive tools. Investors are always trying to figure out what's coming next and how that's going to affect prices. Whereas the numbers that feed into the orange line, which is measuring the economy, GDP, total economic output, that's all lagging. That's all backward looking, right? The world had already recovered much of the value in financial markets before we could look back and see what was happening to economic output in terms of GDP. And you can see how the orange line kind of follows the purple line, but lags. Are we going to have another recession? We don't know. So many of the indicators that we're looking at are telling an encouraging or positive story. We've talked about inflation moving in the right direction. We've talked about jobs holding steady, on and on and on. We can give you a lot of things to be excited about on a forward-looking basis. And the long and the short of it is nobody knows what's going to happen tomorrow. Dave and I were just having this conversation about how the outlook for 2022 was really positive until February. when Russia invaded Ukraine, and we're going to have more to say about that in our final slide here. What we do know is what's happening in financial markets. We know what we've seen in recent history, and we know that our portfolio is positioned to harness growth wherever it emerges in the market. And whatever's happening in financial markets, again, we have to remind our clients, we have to remind our viewers, there is a bit of a disconnect. Markets are looking forward. Economic information, as it's reported to you, is backward looking. So there will always be a bit of a disconnect between the two. And yet we've got encouraging things to see, encouraging things to look at and focus on both sides. And so finally, we'll end this segment of the presentation with a note on human resilience. Dave shared a link with the team from this past weekend. Fareed Zakaria from CNN was sharing just a piece about the end of the Russia shock. We're not going to rehash all the different pieces. We've spent no small amount of time in past webinars talking about the effects of Russia's invasion of Ukraine over the past year. What was interesting to note in this video was the economic indicators that Zakaria was focused on. So many of the things that people were worried about affecting the globe, the world, economies around the world as a result of this invasion, all those things seem to have kind of leveled off, normalized, and the shock has been absorbed. That was his big takeaway. Food prices, lower than they were at the beginning of 2022 before the invasion. The same for fertilizer prices. The same being true for natural gas prices. And if you'll recall headlines over the past several months, there's been no shortage of angst about how any one of those pieces might just completely send the economy up in flames. Likewise, oil prices lower than they were at the start of the war. Well, how is it that we had such a massive shock? We had so many things to worry about. We certainly did have, a rough year in markets, and yet for us to be in this place, the end of a calendar year, begs the question, how? And so I'll put this text up and just kick it over to you, Dave, to kind of take us home here. You've said it throughout this presentation, human beings are fundamentally resilient, and this provides a bit of an example of that.
Yeah, this is the thing that that is part of our fundamental worldview that informs everything we do, how we plan for your finances in general, and certainly how we think about investing your capital in the markets. And that is the fact that, the world is filled with human beings. We're dealing with, human systems. The economy and the markets are just collective action by human beings. And human beings are ingenious and resilient and adaptable. And this is the thing that happened in the now just about year since the invasion created, someone was asking about the, why look at a measure of inflation that removes the food and energy components, and they are volatile, and we saw that volatility that last year because it did create a huge spike in food prices, fertilizer prices, and energy prices. But what happened? National leaders and companies, they adapted. They, natural gas producers ramped up production dramatically, and they started shipping more of it overseas, and overseas markets started building more terminals to take on the natural gas. And we saw more oil being pumped out of the ground. And these have spillover effects because, we talk about fertilizer prices being lower. Well, part of the reason that is that natural gas is a huge input into the production of fertilizer. And so if natural gas prices drop, fertilizer prices drop, the cost of food drops. If the cost of gas is going down, the mechanized component of mass agriculture goes down, the operating expense goes down, and farmers planted more food. So farmers planted more food, the prices of their inputs went down, and all of these things happen in less than a year. And they happened in less than a year, not because of any single thing, but because of the collective action of public leaders, private leaders, and the invisible hand of the market, just spontaneously adapting to a shock. And so this is the thing, is that what we saw last year in terms of, the markets gave very attractive returns in 21, and then not so much last year. Part of that was a spike in inflation, which scared investors, and a big part of that was that huge spike in oil, or I should say, energy and food prices that were in large part triggered by the Russia's invasion of Ukraine, and the world adapted. The world always adapts, and so this is just one more example of our fundamental worldview proving itself out in a fairly narrow window. So we'll see where that takes us. I think it creates actually, sort of one more piece of the puzzle for the Fed, one more piece of puzzle for the economy, one more positive indicator that we may very well have a soft landing and the basis for continued growth beyond.
Thank you, sir. And thus concludeth our comments on the economy and financial markets. Lauren, on to you.
Well, not so fast. We've got some really good questions that I want to, some juicy ones, some good ones that I think play in. And similar to your promise about the bonds and a digest article, there's already a piece that covers what I was planning to talk about. So I'll go through the high hitters if we have a few minutes and make sure that everyone has that article when we post the recording. But just Dave, what you were just saying about, resiliency and the world coming through, a question that's specific to the United States. What about 2023 and the debt ceiling and the potential issues that could cause?
So here's, first of all, we've seen this show before. You had Newt Gingrich, who was head of the Republican majority back in the 90s when Bill Clinton was president, shut the government down at one point and threatened not to increase the debt ceiling. In 2011, there was a threat again by a Republican majority in the House to not increase the debt ceiling. And then we had the fiscal cliff, which was a variation of that in 2013. I mean, this is a roadshow that keeps coming back to town, and it's done for performative reasons generally. I mean, the thing about the debt ceiling is there's no choice. The debt ceiling is not about future spending. The debt ceiling is about paying for spending that's already taken place. If you want to reduce future spending, that's fine, but you got to pay for what you've already committed to and spent. And it would be economically catastrophic, as I think the question actually may have used that word, but it would be economically catastrophic if in fact the US didn't increase the debt ceiling and ultimately could not make good on its debts. But I don't believe it's going to happen. I believe the show will look just like it has in the past. I think there'll be some brinksmanship, and I think in the end, cooler heads will prevail because everyone is well aware of the consequences, and that's why a certain small segment of our body politic uses it as a threat, because it's like threatening. It's like Vladimir Putin threatening to use nuclear weapons. If you think you can make it sound like a credible threat, it's a really big threat. I don't believe that the majority of people in Congress, certainly not the Senate, and I do not believe that a majority of the House would ever agree to renege on our debt. So I think there'll be some brinksmanship. I think there'll be some press conferences, but in the end, I think we'll see what we saw before. In the end, we'll get the increase we need, and the economy will move on.
Right.
This is the other thing, is that this would be a high impact event, but I believe it's a low probability event. It would be, in some ways, it's kind of like arranging your garden on the belief that a meteorite's going to destroy your yard. I mean, that doesn't violate the laws of physics, but it's such a small probability that you don't want to build your life around it. And so we feel like it's best to, first of all, build resilience into your affairs. And secondly, and if half your portfolio is invested outside the US, then that helps. And secondarily, to build resistance in the rest of your financial life. But most of all, not to make bets on what we believe to be low probability outcomes.
Thank you, Dave. So I have two more questions here that I think go really well together. And the first one is, it seems to me it would be better to put our money under the mattress during a down market and come back to you when there's a change. You're focusing on how you've done better, but there's still a big loss, which we are of course not negating. We depend on that money as we are retired and are living on our portfolio. What are your thoughts on that? So I think that's a really good one. And along with that, a question of when do we expect our portfolio to again show positive returns? So I feel like those two go well together from the day-to-day management and forward outlook.
Well, your portfolio has shown really nice positive returns since the end of September. Since the end of September last year until whatever, a few days ago, I think the average portfolio is up over 20%. And so that's the thing, is like sometimes it's hard to see things when you're in the middle of them. And that's you can see the upward trend in this chart. Since the end of September, the portfolios have been rising month after month very strongly, and including through the first half of this month. And so, yeah, it's all coming back. It would have been terrible 3 months ago to put your money in a mattress. You'd have lost the whatever it is, 20. I think the number is actually 26% since the end of September. That's the problem with the thought that, well, let's put our money someplace safe, and I'm going to use air quotes there. Let's put our money safe until things start to recover. The problem is, you wake up 3 months later and it's like, oh, we missed a 26% rise because we were waiting for things to look better. They're looking better, but you might not even have noticed that. You might not have noticed it for another month or 6 months or whatever. So it's really, unfortunately, we think it's a recipe for missing the recovery, because recoveries tend to be very discontinuous. They happen very quickly. Declines often happen very quickly. Recoveries happen very quickly because sentiment in the market shifts just turns on a dime. I haven't left much oxygen in the room, Yusuf, but by all means add to that.
No, yeah, I'm just going to add and just point back to the picture here. I mean, if we can use recent history as an example, we all remember what things felt like, what the world felt like in the summer of 2020. If you had waited until just the beginning of July to get back into the market, you missed all of this. And, that kind of a miss in terms of a portfolio's long-term efficacy can be cataclysmic. So it's why we never advise getting out. It's just because you can't time it right to get back in. And usually you can't time getting out right either. And it's just too risky. There's too much to lose on both ends.
And back to this theme of resilience is that, we try and build resilience into your affairs. And so if you're retired, we've planned for you to have 6 to 7 years worth of spending from a relatively stable reserve of bonds and cash, so that you don't have to touch your stocks. And it's a tremendously rare event to see stocks not recover within 6 years. And in fact, we haven't seen that for, I don't know what. Even back in the Great Recession, it recovered in less than 6 years. So we're really being cautious by building that much of a reserve, a spending reserve. But that's the key, is that there's plenty of time for stocks to recover. We're already seeing what looks like it might be the beginning of a recovery. We're back where we were in the middle of July 21, the year before last. I would say, I actually won't repeat myself. That's always a risk.
Well, and, just to add is that, under the mattress might feel safe, but inflation makes it so that it's not. And so, cash was at risk this past year as well. So, I mean, we are biased, but not without reason. Having your money invested, we think, in the long run makes the most sense.
Right. And we've got your mattress. We've got a year's worth of cash always. And although bonds took a little bit of a hit, they've actually started to recover. Something we didn't spend time on today, but bonds can turn on a dime too, because they're so sensitive to interest rates. and interest rate expectations. And so bond prices have been rising quite a bit. And Yusuf will share that in a in a digest post. But that's another area of bright spot. And it never had as much downside as stocks to begin with. So that was the quasi mattress, and the cash was the mattress. And you've already got it.
Any other questions left on the list, Lauren?
Nope, I think we're good. And I'm going to do I'll do a super speed round, like see if I can do 15 seconds a slide. And then what I'm going to do is I'm going to I'll record a little soundbite to go through my slides and these pieces that will go along with the piece that I wrote for the Live Big Way Digest. And I am planning to write another piece because the Secure Act, part of the Consolidated Appropriations Act of 2023, signed into law December 29th last year, over 4,000 pages, of which the Secure Act 2.0 is part of it, and it includes over 100 changes that could potentially affect someone in the United States. And so we've put together a list of some of the biggest or heaviest hitters. So if we go to the next slide, one of the big ones that if you are anywhere near RMD age, you probably have heard of or are thinking about, RMD age was delayed again. So back in 2020, it was delayed from 70.5 to 72. It has now been delayed to 73, and in 10 years will be delayed again to 75. So the short point here is if you turn 72 this year, you get a special birthday present from the government and that you don't have to take your first RMD until next year. So anyone who was planning to take their very first RMD this year, that required minimum distribution from your retirement accounts, you will not have to do so. And next year will be the year, and we will be reaching out directly to you all. And if you have already started your RMDs last year, unfortunately for you, no changes. And if you were born in 1960 or later, your RMD age will be 75. So you'll get a special birthday present then. Another piece that has long been coming are IRA catch-up contributions. That IRA catch-up contribution has been at 1,000 for a long time, and it will finally be indexed for inflation starting next year. So that will start to go up. And similarly, catch-up contributions, this is a very specific rule. If in the years you turn 60, 61, 62, or 63, you'll be able to do a supercharged catch-up contribution, the greater of 10,000 or 150% of the current catch-up. So for example, if you are 61 this year to your employer retirement plan, you could do a catch-up contribution in addition to the maximum of $11,250. So it's just giving a bit of a window for some supercharged catch-up contributions for those turning those ages in those calendar years. All right, lots of Roth changes, lots of focus on Roth accounts. And we all know that Roth accounts can be really powerful. You let your money grow tax-free forever, but you do contribute after-tax money. So small changes here, or small things that will now be options. If you have a simple IRA or a SEP IRA, there will now be Roth versions of those accounts allowed, where you put in after-tax money and it grows tax-free forever. Employers will also be able to contribute or make their matching contributions to employee accounts to the Roth portion of the account. As I said, it has to be after-tax income in a Roth account, so that money will be taxable to the employee if they choose to have their match done via a Roth match contribution. And then next year, no more RMDs for Roth employer retirement accounts. I'll comment more on that in the soundbite, just in the interest of time. If you earn more than $145,000 in a year, your catch-up contributions will be required to go into a Roth portion of an account. And there's a new option to move money or roll over money from a 529 to a Roth IRA. And there are some nuances there. So check the article or the soundbite, and there's information there about how that
or call us up.
Or call, email, and those don't start until 2024. So nothing can be done this year anyway. Two big changes. First one is really a great change in our opinion, automatic enrollment. So starting in 2025, any new employer 401k plan will require automatic enrollment for all employees at an initial rate of at least 3%. That initial rate can be up to 10, and there will be an automatic increase applied 1% a year until the employee's contribution rate is 10% of their income. This is all opt-out. It is not forced, but it is automatic enrollment, and that leads to a lot better participation. There have been a lot of studies actually done. The one I know best is about organ donation, and two countries very similar, opt-in versus opt-out. And so opt-in is really great to get people to participate in the wonderful benefit of employer retirement accounts. And automatic increase makes sure that they're increasing that savings amount over time. And the other one is for missed required minimum distributions. Previously, if you missed an RMD, you had to not only take the RMD from the account, but pay 50% of it in tax. Now it's a 25% penalty if you miss it. And if you correct it within the correction window, which has not been defined, it's only a 10%. So more guidance will be coming on what that correction window is. But it is beneficial, you know, if you make a mistake or you just forget about an account or something happens, it's in transit and you forget, the penalty is a lot lower now. And the final one, just quickly, is that there's a new rule that spouses can elect to be treated as their deceased spouse for RMD purposes. So if your spouse was significantly younger, you could inherit their IRA in a separate account and choose to be treated as them and not have to take RMDs until they would have turned whatever their RMD age would have been, 73 or 75 based on birth year. So that was about as fast as I could go through that. I will record a soundbite with more information on all of these pieces. There is a digest piece and you can always call or email us and we can talk more.
Thank you.
Well, yeah. Thank you.
There have been no further questions. So yeah, thank you all for being here.
We always enjoy
Remarks?
talking with you. Yeah.
Yes.
No, the only final words are, you know, thank you as always. You know, Lauren has said it, email us, call us. You know, we want to talk to you about any of this stuff. And if you're one of our clients and there's something that applies to you, you could probably expect us to be talking to you about it proactively. But if you have questions in the meanwhile, we hopefully will have answers. So thank you again and have a great day.